Before we dive in, please remember that this presentation is for educational and informational purposes only. I am not a financial advisor, and the information provided in this video does not constitute financial, legal, or tax advice. The mortgage and real estate industries are complex and subject to change. Always consult with a qualified and licensed professional before making any financial decisions related to purchasing a home. Your financial situation is unique, and the strategies discussed here may not be suitable for you. Imagine this for a second. You did it. After months of searching, you found the one. The perfect house. It has the big backyard for the dog, the updated kitchen you've been dreaming about, and it's in a great school district. You go through the mortgage process, which feels like a blur of signing documents you don't really understand. Your loan officer is friendly, fast, and keeps saying, "Don't worry, we'll get it done." And they do. You get the keys, you pop the champagne, you start your new life. It's perfect. Until it isn't. 6 months later, a letter arrives from a company you've never heard of. Your mortgage has been sold. And by the way, your monthly payment is going up by $700. Panic sets in. You scramble to find the paperwork, your heart pounding in your chest as you read the fine print you glazed over. It was an adjustable rate mortgage. You call the friendly loan officer who rushed you through the process. The number is disconnected. This isn't a fictional horror story. This is a quiet catastrophe playing out in neighborhoods all across America. And it's a direct result of a broken system that most homebuyers don't even know exists. The problem is, the vast majority of the mortgage industry is built on a simple, dangerous premise: speed and transactions. Get the loan closed, get the commission check, and move on to the next one. The person guiding you through the single largest financial decision of your life often has the same business model as a fast food drive-thru. They are not incentivized to educate you. They are not rewarded for protecting you. They are rewarded for volume. And in that gap, the gap between what they are paid to do and what you need them to do, is where financial futures are ruined. But what if there was a different way? What if there was a class of mortgage professional who operated under a totally different philosophy? A professional whose primary job wasn't to sell you a loan, but to educate you on a strategy? A person who saw themselves not as a salesperson, but as a long-term financial guide? They exist. They're called mortgage educators. And learning how to find one, and how to leverage the hidden safety net of compliance reviews, is the single most important thing you can do to protect yourself and your family when buying a home. Over the course of this presentation, I'm going to pull back the curtain on the entire mortgage industry. I'm going to give you a bulletproof framework to ensure you are never a victim of that nightmare scenario. You will learn the exact questions to ask to unmask a transaction-focused loan officer in the first 5 minutes of conversation. You will understand how to turn complex mortgage documents from a source of anxiety into a tool of empowerment. And you will discover the behind-the-scenes compliance checks that act as your last line of defense against predatory practices, and how you can use that knowledge to your advantage. This isn't just about getting a low interest rate. It's about building a secure financial future on the foundation of the right home loan. So let's talk about the two parallel universes of home financing. Let's invent a family, the Millers. They're first-time homebuyers, excited, a little nervous. They've saved up a down payment and are ready to make their move. In Universe A, the Millers click on the first ad they see online that promises record low rates and 10-minute pre-approvals. They get connected with a loan officer we'll call Transaction Tom. Tom is all energy. He says, "Great news, you're pre-approved for $500,000. Let's get you out there shopping." He sends them a link. They upload their documents. He doesn't ask them about their 5-year plan, their career goals, or if they're thinking of having another child. He doesn't discuss the difference between a 15-year and a 30-year loan beyond the monthly payment. He certainly doesn't explain what mortgage insurance is, how it works, or the specific strategies they could use to get rid of it faster. The Millers find their dream house. It's at the top of their budget, but Tom says, "No problem, we can make this work." He presents them with a loan option that has a surprisingly low initial payment. He breezes past the term 5-to-1 ARM, just saying it's a great starter product that keeps their payments low for the first few years. The Millers, trusting the expert, sign the massive stack of papers at closing. They're homeowners, but they've just unknowingly started a 5-year countdown on a financial time bomb. Now let's look at Universe B. Here, the Millers get a referral from a friend to a loan officer we'll call Educator Emily. Their first conversation with Emily is completely different. She doesn't even talk about interest rates for the first 20 minutes. Instead, she asks questions. Tell me about your jobs. Do you expect your income to grow, stay the same? Or are you thinking of a career change? Where do you see yourselves living in 7 years? Is this a starter home or a forever home? What's more important to you right now? A lower monthly payment or building equity as fast as possible? She's not just processing an application, she's diagnosing their financial life. She's building a mortgage strategy that fits their goals, not just their credit score. Emily then presents the Millers with 3 distinct options. Option 1 is a standard 30-year fixed-rate loan. She explains exactly how amortization works, showing them a chart of how little principal they'll pay off in the first few years. Option 2 is a 15-year fixed rate. The payment is higher, but she shows them that they would save over $180,000 in interest and own their home free and clear 15 years sooner. Option 3 is a special loan program for first-time buyers that offers a lower down payment, but she is brutally honest about the cost of the mortgage insurance that comes with it. She shows them the exact date, years from now, when that insurance is projected to fall off, and gives them 2 strategies to accelerate that timeline. She even discusses the 5-to-1 arm that Tom pushed in the other universe, but she calls it what it is, a calculated risk. She walks them through the worst-case scenario, showing them what their payment could balloon to if rates rise. The Millers feel a sense of clarity and control they never imagined possible. They choose the 30-year fixed, confident that it's the right stable choice for their growing family. They buy a slightly less expensive house than their maximum approval, because Emily's education empowered them to prioritize long-term financial health over short-term gratification. The difference between these 2 universes is not the interest rate. It's not the loan program. It's the philosophy of the guide. Transaction Tom created a customer. Educator Emily created an educated client. And this is where the idea of compliance comes in. It sounds like a boring corporate buzzword, but in the world of mortgages, compliance is your suit of armor. Every mortgage application by law has to go through layers of compliance review. These are checks and balances designed to prevent the exact nightmare Tom created for the Millers. They check for things like the ability to repay, ensuring the lender has done its due diligence to confirm you can actually afford the loan, even if the rate adjusts. They review the loan estimate and closing disclosure documents for accuracy, making sure the numbers you were promised are the numbers you actually get. But here's the secret. A transaction-focused loan officer views compliance as a hurdle. It's a box-checking exercise they have to get through to get paid. An educator, on the other hand, builds compliance into their process from the very beginning. Emily's deep dive into the Millers' life goals wasn't just good customer service. It was the foundation of a compliant, suitable loan. By understanding their full financial picture, she ensured the product she recommended was genuinely in their best interest. She wasn't just trying to avoid red flags from the compliance department. She was making sure there were no red flags in the Millers' future. Relying on the formal compliance review to catch a bad loan is like relying on a smoke detector to learn how to cook. It only alerts you when the fire has already started. The true power lies in working with someone whose process is so thorough, so educational, that the final compliance check is merely a formality, a rubber stamp on a strategy you already understand and control. The goal isn't just to get a loan that is compliant. The goal is to get a loan that is correct for you. And that journey starts not with a rate but with an education. So what does that education actually look like? For most people, the mortgage process feels like a black box. You feed your most sensitive financial documents into one end, and you pray that a key to a house comes out the other. In between, you're bombarded with jargon, checklists, and urgent requests from people you've never met. The entire system is designed around one thing: speed. Get the file from application to closing as fast as humanly possible. It's a factory assembly line. But your life, your finances, your future, that's not an assembly line product. It's custom. It's unique. And forcing a custom life into a standardized box is where the nightmares begin. The industry has pushed this narrative that the mortgage is a commodity, like a gallon of milk. The only thing that matters is the price, the interest rate. Go online, compare rates, click a button, and you're done. This is, without a doubt, the most dangerous lie in personal finance. A low advertised rate is a marketing gimmick. It's the cheese in the mousetrap designed to get you to click, to get you to apply, to get you into the system. Once you're in, the machine takes over. You're no longer a person, you're a file number, a task in a project management system. And the person you might talk to, if you can even get the same one twice, is often a junior-level employee in a call center, reading from a script with zero authority to solve a real problem. They're not paid to educate you. They're paid to move your file to the next stage of the assembly line. This is the transactional model. And it works perfectly until it doesn't. It works for the simplest, most vanilla W-2 employee with an 800 credit score and 50% down. For everyone else? For the small business owner, the freelancer, the person with a new job, the couple trying to use gift funds, the individual with a complex bonus structure? It's a recipe for disaster. Because the assembly line isn't built for nuance. It sees a deviation from the script not as a detail to be understood, but as a defect to be rejected. Let me tell you about a couple, we'll call them David and Emily. They were the perfect picture of the American dream. Both had great jobs, they'd saved diligently for years, and they had pristine credit. They were ready. They did exactly what the internet told them to do. They went to a big shiny online lender with a Super Bowl commercial and a slick app. They were pre-approved in minutes. Felt so easy, so modern. They were ecstatic. They found a house they adored in a great school district, put in a competitive offer, and to their shock, it was accepted. The 30-day closing clock started ticking. For the first 2 weeks, everything seemed fine. They uploaded documents through the portal. They got automated email updates. Your file is in processing. Your file is in underwriting. Felt professional. But then a strange silence. The updates stopped. Their emails to the generic team address were met with vague, canned responses. We're working on it. Underwriting is reviewing. When they tried to call, they got a different person every time, none of whom knew the specifics of their file. They just kept being told to check the portal. The anxiety started to build. The seller's agent was calling their agent, asking if everything was on track. The moving truck was booked. Their landlord had already found a new tenant for their apartment. Their entire life was packed in boxes, literally and figuratively, waiting for a green light that seemed to be dimming. 10 days before closing, the bomb dropped. Not a phone call from a senior advisor who understood their situation. Just a cold automated email. Loan status, denied. No explanation. No next steps. Just denied. Panic. Tears. Frantic phone calls that went to voicemail. They finally got a hold of a low-level processor who mumbled something about undisclosed liabilities and income calculation issues. It turned out, Emily had co-signed on her younger sister's student loan 5 years ago. She had completely forgotten about it because her sister had never missed a payment. And David received a one-time signing bonus when he started his new job 18 months ago, which the automated system couldn't distinguish from his regular salary, so it flagged his income as inconsistent. These were not deal killers. They were details. Details that a conversation, an actual human conversation at the beginning of the process, would have uncovered in 5 minutes. But David and Emily didn't have a conversation. They had an interface. They didn't have an advisor. They had an algorithm. And so, because of 2 solvable, explainable details, their dream was dead. They stood to lose their earnest money, $10,000, and worse, the house they had already fallen in love with. They were completely and utterly broken. This is the cost of the commodity myth. The price of choosing a lender based on a slick app and an advertised rate. This is where the idea of a mortgage educator isn't just a nice-to-have. It's the entire game. Through a friend of a friend, they were introduced to a different kind of loan officer. This person didn't start by sending them a link to an application. She started by scheduling a 60-minute call. She asked them to tell her their story. Not just their financial story, but their life story. What were their career goals? Were they planning on having kids in the next few years? What was their comfort level with financial risk? She dug into David's pay structure, asking for his employment offer letter to document the signing bonus correctly. She asked about Emily's family, and if there were any financial ties they should be aware of. The student loan came up in 2 minutes. Instead of seeing a problem, the educator saw a plan. She explained to them why the first lender's automated system flagged these things. She taught them about debt-to-income ratios and how co-signed debt is treated by underwriters. She explained the rules around documenting one-time bonuses. She wasn't just collecting documents. She was connecting the dots. She was building a narrative for the underwriter, painting a complete, accurate picture of their financial strength. She wasn't an order taker. She was a strategist. She restructured their application, sourced it to a lender whose guidelines were a better fit for their specific situation, and wrote a detailed letter of explanation to the underwriter to preemptively address the bonus and the co-signed loan. She called the seller's agent personally, explained that the buyers were exceptionally qualified, but had been failed by their initial lender, and confidently negotiated a 1-week closing extension. Throughout the process, she communicated with them constantly. They never once had to wonder what was going on. They had a single point of contact, a trusted expert who was in their corner. 15 days later, David and Emily closed on their house. The rate was a fraction of a percent higher than the one the online lender had initially advertised. But the first rate was imaginary. It was vaporware. It didn't matter how low it was because the loan was never going to close. The second rate was real. It came attached to a closed loan, a set of keys, and a future. More importantly, it came with an education. David and Emily finished that process not just as homeowners, but as smarter, more confident financial consumers. They understood their own balance sheet better than ever before. They knew exactly why their loan was structured the way it was. The fear and confusion were replaced with confidence and clarity. The educator performed the ultimate compliance review, not for the bank but for the borrower. She ensured the loan was compliant with the reality of their lives. That's the critical difference. One system is designed to find reasons to say no. The other is designed to find a responsible way to say yes. One treats you like a number in a machine. The other treats you like a partner in a strategy. The tragic part is that millions of Americans are still being fed into the machine, convinced they're getting a deal, when in reality they're just rolling the dice with the biggest financial decision of their lives. They're mistaking a pretty user interface for sound financial advice. And the industry is counting on you not knowing the difference. So let's talk about what happens when you don't know the difference. Let's talk about the Davis family from Austin, Texas. This isn't their real name, but their story is painfully real, and it happens every single day. The Davises were smart people. He was a software engineer, she was a graphic designer. They saved for years, built up their credit, and were finally ready to buy their first home. They did what everyone does, they went online. They found a slick, modern-looking mortgage company with a cool app and a killer advertised interest rate. It was 0.5% lower than what the local guy their realtor recommended had quoted them. 0.5%. On a $400,000 loan, that felt like a lottery win. The process was a breeze. They uploaded documents to a portal. They got automated text message updates. They barely even spoke to a human being, which in their busy lives felt like a feature, not a bug. They felt so savvy, so modern. They were getting a mortgage on their phone while their parents had to sit in a stuffy bank office for hours. They were winning. 2 weeks before their scheduled closing date, they got their final closing disclosure. And their hearts sank. That lottery-winning interest rate? It was there. But to get it, the lender had charged them 2 points, a fee of 2% of the loan amount. That was an $8,000 charge they had never discussed. Buried deeper in the 5 pages of dense numbers was another surprise. A processing fee of $1,500 that was much higher than the initial estimate. All told, their closing costs were nearly $10,000 more than they had budgeted for. They were $10,000 short of closing on their dream home. When they frantically called the 1-800 number, the friendly voice on the other end was gone. They were talking to a closer in a different state who said, "Well, it was all in the initial loan estimate you signed." And technically he was right. It was there on page 2 in a box labeled origination charges, written in a way that's almost intentionally confusing. The Davises had been so focused on the interest rate, the big shiny number, that they missed the fine print. They had a loan officer who was a glorified order taker, not an educator. No one ever sat them down and explained that the interest rate and the closing costs are like a seesaw. When one goes down, the other often goes up. No one explained how to read the loan estimate, what to look for, or what questions to ask. They were given a tool, not advice. They had a calculator, not a guide. Their choice was brutal. Either drain their emergency savings, the money set aside for a new water heater or a medical bill, or lose the house and their earnest money deposit. This is the devastating, hidden cost of a system that prioritizes speed and convenience over clarity and education. The Davises story is the direct result of a process that skips the most crucial step, the education. A true mortgage professional isn't just a salesperson. They are, first and foremost, a mortgage educator. Their job isn't to get you to sign on the dotted line as fast as possible. Their job is to make sure you understand exactly what you are signing. A mortgage educator slows the process down at critical moments. They don't just send you a document to e-sign. They get on the phone or a video call and walk you through it, line by line. They explain the difference between the loan estimate and the closing disclosure. They proactively point out every single fee and explain what it's for. They don't just tell you your rate. They show you 3 different rate options and explain the pros and cons of each. Maybe you pay a slightly higher rate to get a lender credit that covers most of your closing costs. Maybe you pay more in costs to get the absolute lowest rate for the long haul. There is no single best option. There's only the best option for you, and you can't make that choice if you don't understand the trade-offs. An educator asks the hard questions. Not just, can you afford this payment? But, have you factored in the 15% property tax increase that's coming next year? Not just, do you have your down payment? But, will this leave you with enough of a cash cushion for emergencies? They talk about total cost of ownership, taxes, insurance, maintenance, not just principal and interest. They are a financial strategist helping you with the biggest purchase of your life. The button-pushing, app-based lender is designed to do the opposite. It is designed to remove friction. But in a transaction this complex, friction is a good thing. Friction is where questions get asked. Friction is where understanding happens. Friction is what saves you from a $10,000 surprise. Now you might think, okay, I get it. I need to find a loan officer who is a good teacher. But how can I trust them? How do I know they're not just a smoother salesperson? This is where the second invisible hero of our story comes in. The compliance review. Compliance. I know. It's the most boring word in the English language. It sounds like corporate jargon, red tape, and soul-crushing bureaucracy. But in the mortgage world, compliance is your suit of armor. It is the only thing standing between you and the Wild West of lending. After the 2008 financial crisis, which was caused in large part by reckless and predatory mortgage lending, a whole host of new laws were passed. Laws with names like the Dodd-Frank Act, and regulations like the TILA-RESPA Integrated Disclosure Rule, or TRID. Again, I know it sounds awful, but think about what these rules actually do. TRID, for example, is the reason the devices even had a leg to stand on. It's the rule that mandates lenders give you a standardized, easy-to-read loan estimate form at the beginning, and a standardized closing disclosure form at the end. The rule says that most of the numbers on that first form can't change very much by the time you get to the last form. It's what stops a lender from bait and switching you with surprise fees at the last minute. The problem for the devices wasn't that the rule didn't exist. It's that no one had educated them on how to use the armor it provided. A rigorous compliance review, done by a dedicated department within a mortgage company, is like having a team of lawyers triple-check your contract before you sign it. They aren't on the sales team. They don't make a commission. Their only job is to make sure the rules are being followed to the letter. They check to see if the loan officer properly disclosed everything. They verify that the fees are legal and justified. They ensure that the loan you're being given is one that you actually have the documented ability to repay. A shockingly novel concept that wasn't a hard and fast rule before 2008. They are the internal affairs of the mortgage world, and good, ethical lenders invest heavily in them. They see compliance not as a burden, but as a promise to their customers. It's a commitment that says, we're not just trying to make a sale. We're trying to build a safe, sustainable financial future for you, and we're doing it by the book. The fast and easy online lenders? They often treat compliance as a box to be checked, a hurdle to be cleared with the least possible effort. Their systems are built for speed and volume, and deep, meaningful compliance reviews are the enemy of speed. So they automate it using software to scan for basic red flags, but potentially missing the nuance that a human expert would catch. A human expert who might ask, wait a minute, does the client understand that their property taxes are going to be reassessed, and this payment will jump by $400 in 6 months? The algorithm doesn't ask that. It just checks if the number in box F matches the number in box G. So you have these two powerful forces that are supposed to protect you. The mortgage educator on the front lines, and the compliance review as your backup. One provides the knowledge, the other provides the enforcement. When they work together, the system is beautiful. It's safe. It empowers you to make a confident, informed decision. But here's the scary part. This entire protective system is being systematically dismantled. Not by changing the laws, but by changing consumer behavior. The new breed of lender has figured out that the weakest link in this armor isn't the law, it's human psychology. And they've turned your own desire for speed and convenience into their most powerful weapon. The most effective trap isn't one you have to be forced into. It's one you willingly, even eagerly, walk into yourself. And the key to building that trap is understanding a fundamental truth about modern life. We are all addicted to easy. We crave simplicity. We've been trained by a decade of technological revolution to expect instant gratification. You want a ride? Tap a button. You want food? Tap a button. You want to buy virtually anything on earth and have it at your door tomorrow? One click. We don't just prefer this, we now demand it. And lenders know it. So they looked at the mortgage process, historically a mountain of paperwork, confusing conversations, and weeks of anxious waiting. And they saw their opportunity. They asked, how can we make this feel like ordering a pizza? The result is the slick, app-driven, rocket-fast mortgage experience that now dominates the market. It's a masterpiece of user interface design. It's clean. It's intuitive. And that ease is the most deceptive part of the entire system. Because this isn't just about customer service. It's about cognitive control. Every single element of that simplified process is engineered to do one thing: reduce the amount of time you spend thinking. Think about the mental state you're in when you're buying a home. It is, for most people, the most stressful and complex transaction of their lives. You're juggling real estate agents, home inspectors, sellers, moving companies. You're emotionally invested. You're picturing your kids' rooms. You're dreaming of the backyard barbecues. Your brain is running at 110% capacity. Psychologists call this a state of high cognitive load. Your mental bandwidth is almost completely maxed out. The old mortgage process added to that load. It was another complicated, stressful thing to deal with. But the new, streamlined process does the opposite. It offers relief. In a sea of complexity, it presents itself as a simple digital island of calm. Don't worry about this part. The app seems to whisper, we've got it. Just upload this document. Just e-sign here. Look, a friendly green check mark. You're making progress. This feeling of relief is incredibly powerful. It triggers what's known as decision fatigue. It's the same reason that after a long, hard day at work, you're more likely to order takeout than cook a healthy meal. You just don't have the mental energy left to make another good, rational decision. Lenders are counting on this. They know that after you've spent weeks fighting to find the right house and win a bidding war, the last thing you want is to spend another 2 weeks painstakingly comparing the microscopic details of loan estimates from 3 different lenders. You just want the keys. You're so focused on the finish line of getting the house, you'll accept the first financing option that feels easy and doesn't immediately set off alarm bells. The path of least resistance becomes the most attractive path, even if it leads off a financial cliff. It's the classic car dealership tactic, magnified by 1,000. You spend 4 hours negotiating the price of the car, the trade-in value, the color. You feel like you've won. You're exhausted. Then they shuffle you into the finance manager's office. This is where they make their real money. They flash a monthly payment on the screen, and your tired brain just wants to say yes. They offer extended warranties, paint protection, and VIN etching. You're too worn down to argue, too fatigued to do the math. You just sign. The mortgage industry has perfected this model. They've turned the entire home buying journey into the long, exhausting negotiation, and their 5-minute mortgage application is the finance manager's office, ready to capture you at your weakest moment. Then they layer on another powerful psychological trigger: urgency. They have masterfully blended the real, market-driven urgency of buying a house with an artificial, lender-created urgency for choosing a loan. This is the new battlefield. The fight for a fair mortgage is no longer taking place on paper. It's taking place inside your own mind. The system is no longer designed to hide the truth from you. It's designed to make you not care enough to look for it. This is why the role of an independent mortgage educator, of a third-party compliance review, has become absolutely critical. They are the essential human circuit breaker in an increasingly automated, dehumanized process. They are the only force that can hit the pause button on your behalf. They've built a frictionless superhighway directly to a 30-year financial commitment, and they've meticulously removed all the off-ramps and speed bumps. So what happens when you're barreling down this highway at 100 miles an hour, and suddenly realize you're heading in the wrong direction? The answer to that question reveals the true, hidden cost of convenience. A cost measured not in dollars but in decades. That wrong turn isn't a sudden screeching U-turn. It's a subtle drift. It's a series of seemingly harmless lane changes, each one presented as a shortcut, a time saver, a path of least resistance. You're offered a loan with a teaser rate that looks unbelievably low, so you take it. You're told not to worry about the mountain of paperwork, just sign here, here, and here, so you do. You're nudged toward a lender who promises a lightning-fast closing. And in the frantic rush to get the keys, speed feels like the most important thing in the world. Each decision in isolation makes perfect sense. It's convenient. It's fast. Gets the deal done. But But convenience is a siren song, and its melody can lure your financial ship straight onto the rocks. The true cost is a slow-motion car crash that unfolds over 5, 10, even 20 years. It's the phone call you get in year 3, when your adjustable rate mortgage resets and your monthly payment suddenly jumps by $700. It's the moment you decide to sell or refinance and discover a prepayment penalty buried on page 87 of your closing documents. A penalty that costs you $10,000 just for the privilege of leaving your own loan. It's the slow dawning realization that the no-cost loan you were sold actually baked thousands of dollars in fees into a higher interest rate, forcing you to pay for those free services again and again, every single month, for the next 3 decades. Your dream home, the place that was supposed to be your sanctuary and your greatest asset, slowly transforms into a financial prison. The equity you thought you were building is being siphoned away by hidden clauses and misunderstood terms. That's the cost. It's a tax on the uninformed, a premium paid for speed over wisdom. So how do you avoid this? How do you navigate a system that seems designed to take advantage of the very people it's supposed to serve? You don't get a faster car. You get a better navigator. You find someone whose only job, whose entire purpose, is to sit in the passenger seat with the map, pointing out the potholes, the dangerous curves, and the dead ends before you ever get to them. In the world of mortgages, this person is not your loan officer. It's not your real estate agent. It's a mortgage educator. Now that term might sound a little academic, a little boring, but don't let the name fool you. A mortgage educator is your financial special forces operator for the home buying process. Their mission is fundamentally different from everyone else you'll meet. A loan officer is a salesperson. A good one is helpful, a bad one is dangerous, but at the end of the day, their primary incentive is to sell you a loan, specifically their company's loan. Their compensation is tied to closing the deal. A mortgage educator, on the other hand, works for you. Their primary incentive is your long-term financial health. They don't sell loan products. They sell clarity. They sell strategy. They sell peace of mind. Think of it this way. When you walk into a dealership, the car salesman wants to sell you a car. When you hire a master mechanic before you buy, that mechanic wants to make sure you don't buy a lemon. The mortgage educator is the master mechanic for the single biggest financial decision of your life. They aren't tied to any bank or lender. Their loyalty is to you and you alone. Their job is to deconstruct the entire process, to translate the dense, impenetrable jargon of the financial world into plain English you can actually understand. They're the ones who will sit down with you and explain not just what an escrow account is, but how it can be used strategically. They'll explain the profound, long-term difference between a 15-year and a 30-year mortgage, not in terms of the monthly payment, but in terms of $250,000 in interest and a decade of your life. They run scenarios. What if you get a raise in 2 years and want to pay more? Which loan structure is best for that? What if one of you decides to stay home with the kids and your income drops? Which loan gives you the most flexibility? These are the questions that loan originators, rushing to meet a quota, rarely have the time or the incentive to ask. A mortgage educator builds a financial model of your future, and then helps you find the mortgage that fits that future, instead of forcing your future to fit a prepackaged loan product. And this brings us to their most powerful tool, the single most important checkpoint in this entire journey. It's called a compliance review. If the mortgage educator is your navigator, the compliance review is their high-powered satellite imaging system, capable of seeing through walls and spotting danger from miles away. A compliance review is a forensic audit of your loan documents, specifically the loan estimate and, later, the closing disclosure. These are the 2 most critical documents in the entire home buying process, and for most people, they might as well be written in a foreign language. The review scrutinizes these documents for 3 things: accuracy, legality, and clarity. First, accuracy. Are the numbers correct? Sounds basic, but you would be astounded at how often they are not. We're talking about miscalculated property taxes, padded origination fees, junk fees disguised with vague names like administrative fee or processing fee. These are often small amounts, $100 here, $200 there, that most buyers would never notice. But a trained eye sees them for what they are: a systematic attempt to bleed you dry, one tiny cut at a time. The educator finds these, flags them, and tells you exactly how to challenge them. Second, legality. Does your loan comply with the labyrinth of federal and state laws designed to protect you? Regulations like the Truth in Lending Act, TILA, and the Real Estate Settlement Procedures Act, RESPA, are your armor. But you can't use armor you don't know you have. The compliance review ensures all disclosures are made correctly, that timelines are met, and that there are no predatory terms hidden in the fine print. It checks for those prepayment penalties, for negative amortization clauses where your loan balance actually increases over time, for balloon payments that could force you to sell your home. It is a legal shield that protects you from the most dangerous parts of the industry. But the third check is the most important of all: clarity. The compliance review bridges the massive gap between what you were told and what you are actually signing. The loan officer might have promised you a fixed rate, but is there a clause on page 12 that allows for adjustments? You were told the lender would cover certain closing costs, but does the closing disclosure actually reflect that credit? This is where the verbal handshake meets the legally binding ink. The review ensures there is no daylight between the two. It confirms that the deal you think you're getting is the deal you are, in fact, getting. It's the ultimate defense against the, "oh, I thought that meant," moment. The moment that has cost American families trillions of dollars over the decades. It transforms you from a passive participant, hoping for the best, into an empowered commander of your own financial destiny. So what does that commander do? They don't just march blindly onto the battlefield. They send out scouts. They review reconnaissance. They understand that the most dangerous threats are the ones you can't see. In the world of mortgages, that reconnaissance mission, that expert scout, is the compliance review. Think of the hundreds of pages in your mortgage contract as a minefield. It's a landscape deliberately designed to be complex, filled with legal jargon and financial tripwires. Most of us just walk through it, crossing our fingers, hoping we don't step on anything that blows up our financial future. A compliance review is like hiring a team of bomb disposal experts to sweep the entire field before you take a single step. They know what a bouncing Betty looks like when it's disguised as a document administration fee. They know how to spot a tripwire hidden in the fine print of an adjustable rate rider. This isn't a theoretical danger. This is happening right now in every state to families who thought they did everything right. Let's talk about Mark and Sarah, a couple from Texas. They were thrilled. They'd found their dream home. Their loan was approved, and they were just a week from closing. They got their closing disclosure, that 5-page document that's supposed to make everything clear. They looked it over, and the big numbers, the loan amount, the interest rate, all looked correct. They were ready to sign, but they had a nagging feeling. They'd been watching videos just like this one, and they decided last minute to pay for an independent compliance review. The reviewer got the same documents and started digging. What did they find? A landslide of what the industry calls junk fees. There was a loan processing fee of $400, and an underwriting fee of $600, and a document preparation fee of $150, and an administrative fee of $250. To Mark and Sarah, these all sounded like legitimate costs of doing business, but the compliance expert knew better. They knew that the processing and underwriting fees were often just two names for the same core service, a classic case of double dipping. They knew that the document preparation fee was being charged by the lender, even though the title company was already charging them a separate fee for the exact same thing. The administrative fee was completely unsubstantiated. A fee for what? Administering things? It was a ghost fee, pure profit for the lender, disguised as a necessary cost. The reviewer flagged over $1,800 in these questionable, duplicative, or outright bogus fees. When Mark and Sarah, armed with this detailed report, went back to their loan officer, the conversation changed. There was no more jargon, no more, "that's just how we do it." The lender, caught red-handed, immediately waived every single fee the reviewer had identified. In an instant, Mark and Sarah saved nearly $2,000 on their closing costs. $2,000 that would have just vanished from their savings. A toll paid for walking through the minefield without a guide. They almost stepped on the mine. But some mines are designed to go off years later. Consider the story of the Miller family in Florida. They took out a 30-year fixed-rate mortgage. Their loan officer was fantastic, friendly, helpful, always available. They asked him specifically, "Are there any penalties if we want to pay this off early? My parents are getting older, and we might inherit some money in the next 10 years. The loan officer smiled and said, "Absolutely not. You can pay it off whenever you want. No problem." They trusted him. Why wouldn't they? He was the expert. 5 years later, their situation changed just as they predicted. They inherited enough money to pay off the remaining $250,000 on their home. It was a dream come true to be completely debt-free. They called their mortgage servicer, ready to make the final payment. And that's when the bomb went off. The customer service rep informed them that their loan had a prepayment penalty. If they paid off more than 20% of the loan in any given year for the first 7 years, they would owe a penalty equal to 6 months of interest. For the Millers, that penalty was over $8,000. $8,000 to be allowed to pay back the money they owed. They were devastated. They protested. But our loan officer told us there was no penalty. The servicer's response was cold and immediate. What your loan officer said is irrelevant. What matters is the contract you signed. And buried on page 14 of their mortgage note, in a dense paragraph of legalese, was the prepayment penalty clause. They had signed it. It was legally binding. A compliance review before they signed would have instantly flagged that clause. It would have compared the written contract to the loan estimate, which may or may not have disclosed it properly. It would have created a paper trail questioning that specific term, forcing the lender to either remove it or acknowledge it in writing, cutting through the fog of a friendly, but ultimately incorrect verbal assurance. The Millers learned a brutal lesson. The contract is the only thing that speaks for you when things go wrong. A compliance review makes sure it's saying what you think it's saying. The most insidious traps are the ones that exploit ambiguity. Let's look at a young software engineer in California. Let's call her Priya. She was smart, detail-oriented, and comfortable with numbers. She opted for a 7-to-1 adjustable rate mortgage, or ARM. The initial interest rate was incredibly low, which kept her payment manageable and allowed her to afford a home in a pricey market. She knew the rate would adjust after 7 years, and she read the documents carefully. The contract stated that her new rate would be calculated by taking a specific index and adding a margin. It all seemed very mathematical and straightforward. But a compliance expert reviewing her file noticed something subtle. The contract language describing the index was vague. It didn't specify the exact publication or version of the index the lender had to use. Why does this matter? Because there can be multiple versions of the same financial index. A lender could, if the contract allowed, choose the version that was most favorable to them and most expensive for Priya. Her own worst-case scenario calculation, based on the index she was familiar with, showed her payment might go up by $600 a month. But with the ambiguity in the contract, a compliance review showed that the lender could legally use a different version of that index that would cause her payment to jump by over $1,000 a month. A difference that would have completely wrecked her budget. Armed with this information, Priya's mortgage educator demanded the lender add an addendum to the contract, specifying the exact index, by name, publication, and date, that had to be used for all future adjustments. The lender, knowing they were caught in a legal gray area, had no choice but to agree. Priya locked in a fair, transparent calculation for the life of her loan. She defused a ticking time bomb that could have gone off 7 years in the future, all because an expert knew which sentence in which paragraph on which page held the most risk. This is the power of a compliance review. It's not just about finding typos or calculation errors. It's a forensic analysis of your single biggest financial commitment. It's about uncovering junk fees, identifying hidden penalties, and closing legal loopholes. It's the process of translating that dense, impenetrable contract into plain English, showing you exactly where the risks are hidden. It converts the lender's advantage, their deep familiarity with the system, into your advantage by bringing in your own specialist who knows the game just as well, if not better. It ensures the deal you think you're getting is the deal you're actually getting. So let's talk about what that really looks like in practice. Imagine you're 3 days from closing on your dream home. An email arrives. It contains a document called the Closing Disclosure, or CD. You open it, and it's a dense 5-page document filled with columns of numbers, acronyms, and legal-sounding phrases. Your eyes glaze over. You see the cash to close number and it looks about right? Maybe. You're not a numbers person. Besides, you're busy coordinating movers, packing boxes, and dreaming about where to put the sofa. The lender, the title agent, the real estate agent, they all seem to think it's fine. So you sign. This is the moment where thousands of dollars can be lost in the blink of an eye. Not through malice, but through complexity and human error. This is precisely where a mortgage compliance review transforms from a nice-to-have into an absolute necessity. It's your financial forensic audit. A compliance expert doesn't just glance at that closing disclosure. They put it under a microscope. The very first thing they do is place it side by side with your initial loan estimate, that document you received at the very beginning of the process. The law is crystal clear on this. Certain fees are not allowed to change between these two documents. Others are only allowed to change by a certain percentage. This isn't a guideline. It's a federal regulation under the TILA-RESPA Integrated Disclosure Rule, or TRID. The expert is hunting for discrepancies. For example, that underwriting fee on your loan estimate was quoted at $900. But now, on the closing disclosure, it's listed as $1,400. Why? Was there a changed circumstance that the lender properly documented and disclosed to you along the way? Or did someone in the processing department just input a higher number? Assuming you wouldn't notice the $500 difference amidst the chaos of closing? If there's no valid reason, that's what's known as a tolerance cure. It's a fancy term for a simple concept. The lender overcharged you, they broke the rules, and they are legally required to refund you the difference. A compliance expert will spot this in minutes. The average homebuyer would almost never catch it. That's $500 back in your pocket before you even step into the title office. But they go deeper. They scrutinize the calculation of your annual percentage rate, the APR. The APR is the true cost of your loan, expressed as a yearly rate. It includes not just the interest rate, but also most of the lender's fees. A tiny miscalculation here, even a fraction of a percentage point, can ripple out into thousands of dollars of extra interest paid over the 30-year life of the loan. It's like a tiny navigational error on a cross-country flight. You might not notice it at first, but you'll end up hundreds of miles from your intended destination. The reviewer recalculates the APR from scratch, using specialized software, to ensure it's accurate to the decimal point. Next, they audit the escrows. This is a huge one. Your lender estimates your annual property taxes and homeowner's insurance, divides it by 12, and adds that amount to your monthly mortgage payment. But what if their estimate is wrong? What if they base your property taxes on the seller's lower pre-sale assessment? A year from now, the county reassesses the property at your higher purchase price, your tax bill skyrockets, and your lender sends you a terrifying letter. It explains you have a massive escrow shortage, and your monthly payment is jumping up by $300 or $400 a month, effective immediately. Plus, you might have to pay a lump sum to make up the shortfall. It's a catastrophic payment shock that can derail a family's budget. A compliance expert stress tests these escrow calculations. They look at the new tax assessment rules in your specific county. They verify the insurance premium. They ensure the lender isn't collecting too much, or just as dangerously, too little, cushioning your account and setting you up for a future financial landmine. Think about the story of the Chun family from Austin, Texas. First-time homebuyers, incredibly excited. They'd found a great loan officer who was friendly and responsive. They got their closing disclosure and, like most people, they trusted the process. But a friend who had been through a rough closing urged them to get a second opinion. They reluctantly paid a few $100s for a compliance review, feeling a little silly, like they were questioning their lender. The reviewer called them back within hours. The news was staggering. First, he found a $750 processing fee that was listed as zero on their initial loan estimate. A clear tolerance violation. The lender owed them that money back. Second, he discovered the lender had calculated their initial escrow payment based on the previous year's property taxes, before a major school bond had been passed in their district. The reviewer, familiar with that specific county's tax schedule, projected that the Chins' monthly payment would have jumped by nearly $250 in year 2. The Chins were already stretching their budget. That increase would have been devastating. Finally, and most subtly, the reviewer found that the lender had misattributed one of the title insurance fees, which caused a tiny error in the APR calculation. It was an error so small, just 0.08%, that no one would ever notice. But that tiny error, over 30 years on their $450,000 loan, amounted to over $6,000 in extra interest payments. The compliance expert didn't just find problems, he provided solutions. He gave the Chins a written report and the exact, non-confrontational script to use with their loan officer. "Hi. We were reviewing our documents with an advisor and had a few questions. Could you please clarify the increase in the processing fee and help us understand how the property tax proration was calculated?" Faced with specific, documented evidence, the lender had no choice. They couldn't argue. They immediately issued a corrected closing disclosure. The $750 fee was removed. The escrow calculation was redone, giving the Chins a true, accurate picture of their future monthly payment. The APR was corrected. The Chins walked into their closing not with anxiety and uncertainty, but with absolute confidence. They saved $750 at the table, but more importantly, They avoided a $6,000 long-term overpayment and, critically, the future shock and stress of a massive unexpected payment increase. Their few $100 investment in a review yielded a return of over 8,000%. This isn't an isolated story. It happens every single day in every state. It's not necessarily that lenders are villains trying to cheat you. More often, the mortgage process is a giant, complex machine with many moving parts and many different people involved: processors, underwriters, closers. Mistakes are inevitable. Wires get crossed. Numbers get transposed. A compliance review is simply the final quality control check. A check that is run by an expert who works for you, not for the machine. It ensures that human error doesn't become your financial burden for the next 30 years. So while a mortgage educator helps you understand the strategy of the game you're about to play, the compliance reviewer is the referee who walks onto the field with you, making sure the rules are being followed, line by line, dollar by dollar. They ensure the financial playing field is level. But this all happens at the end of the process. What if the errors in judgment, the costly mistakes, are made far earlier? What if the very loan product you were sold wasn't the best one for you in the first place? Protecting yourself at the closing table is critical, but what about ensuring the entire foundation of the deal was built correctly from day one? That's an entirely different level of strategy, and it's where the real power of education truly shines. This foundation isn't built with concrete and steel. It's built with numbers, disclosures, and conversations. It's laid the very first time you speak to a loan officer. Think about it. This one person, this gatekeeper to the world of home financing, holds an incredible amount of influence over what is likely the largest financial decision of your life. They present you with loan options, they calculate your affordability, they explain the fees, and they guide your expectations. A great loan officer is a priceless partner. They are a true professional who puts your best interests first, meticulously building that strong foundation for you. But what if they're not? What if they're just a great salesperson? What if they're new to the industry and unknowingly make a critical error? Or what if they're under immense pressure from their branch manager to close a certain number of loans that month, and your file is just another unit to be moved? The terrifying reality is, from your side of the desk, it is almost impossible to tell the difference between a true professional and a polished salesperson until it's far too late. You don't know what you don't know. You're relying on them to be the expert, to be your guide. But who is guiding the guide? Who is checking the expert's work? For decades, the answer for the average American homebuyer has been nobody. You were expected to just trust the system. But that's changing. A new layer of protection is emerging. A powerful check and balance that has, until recently, been the secret weapon of only the most sophisticated investors and high-net-worth individuals. This is the world of independent mortgage educators and third-party compliance reviews. Let's break this down, because these two concepts are your ultimate defense system. First, a mortgage educator. This is not a loan officer. They do not work for a lender, and they do not earn a commission for closing a loan. Their only job, their only incentive, is to empower you with knowledge. Think of them as a financial coach for the home buying process. Before you even apply for a loan, you can sit down with an educator. They'll review your financial picture, your income, your credit, your savings, and help you understand what you can truly afford, not just what a lender might be willing to lend you. They teach you the language of mortgages. They explain the difference between an FHA, a VA, and a conventional loan in a way that actually makes sense for your life, not just as a list of features. They arm you with the right questions to ask any loan officer you meet. They essentially give you the playbook before you even step onto the field. Then you have the compliance review. This is more like having a master inspector review the blueprints of your financial foundation. Once a lender gives you that official loan estimate, that critical document outlining all the terms and costs, a compliance expert can conduct a forensic audit of it. They aren't just checking the math. They are scrutinizing every single line item against a labyrinth of federal and state regulations, like the Truth in Lending Act and the Real Estate Settlement Procedures Act. They're looking for miscalculated fees, junk fees, undisclosed terms, or regulatory violations that could cost you thousands over the life of the loan, or even put your entire approval in jeopardy. It is the ultimate accountability tool. To see how this works in the real world, let me tell you about Mark and Sarah, a young couple from Austin, Texas. They were classic first-time homebuyers, incredibly excited, a little overwhelmed, and highly trusting. They'd saved for years and found a loan officer, we'll call him Dave, through a recommendation. Dave was charming. He was confident. He ran their numbers and came back with a pre-approval that was even higher than they'd hoped for. He told them, "With this budget, you can get that dream home in the good school district." They were ecstatic. Dave recommended an adjustable rate mortgage and ARM, explaining that the initial interest rate was fantastic, which would keep their monthly payment low for the first 5 years. He brushed over the details of how the rate could change later, saying, "Don't worry about that, you'll probably have refinanced or sold the house by then anyway." He sent them a loan estimate, and while the numbers were a blur of acronyms and fees, the bottom line payment looked manageable. They trusted Dave. They started house hunting. But Sarah had a nagging feeling. A colleague mentioned in passing that they'd used a mortgage consultant to review their loan. On a whim, Sarah booked a 1-hour virtual session. They sent their loan estimate from Dave over to the consultant ahead of time. That 1-hour call changed everything. The consultant, a former underwriter with 20 years of experience, immediately red-flagged 3 major issues. First, the ARM. She explained in stark detail how, after the initial 5-year period, their interest rate could skyrocket based on market conditions, potentially increasing their monthly payment by hundreds, even $1,000 or more. She asked, "Did Dave show you a worst-case scenario amortization schedule?" They stared blankly. He had not. Second, the consultant pointed to a line item for 2 discount points, a fee of over $8,000. She asked, "Did Dave explain that you are prepaying $8,000 in interest to get that slightly lower initial rate?" Mark said, "He just called it a standard closing cost." The consultant then did a quick calculation and showed them that, based on the small rate reduction, they would have to stay in the loan for over 9 years just to break even on that fee, completely contradicting Dave's own advice that they'd likely sell or refinance in 5. They were paying for a benefit they would probably never receive. But the final point was the knockout blow. The consultant noticed the property tax estimate on the loan estimate seemed unusually low for the neighborhoods they were looking in. She pulled up the county's tax assessor website, found a few comparable homes, and showed them the real tax figures. It turned out Dave's estimate was off by nearly $300 a month. He had used a generic, lowball number to make their total monthly payment, the pity, look more attractive and affordable. Their actual payment on this great deal loan was going to be almost $400 a month higher than they believed. The dream home was suddenly a potential financial nightmare. Armed with this clear, unbiased information, Mark and Sarah knew what to do. They didn't just walk away from Dave, they ran. They found a new loan officer at a local credit union who took the time to explain every single detail of a 30-year fixed-rate mortgage. The interest rate was slightly higher than the ARM's initial teaser rate, but it was stable. It was predictable. It was safe. The new loan estimate was clean, the fees were transparent, and the tax estimate was accurate. They bought a slightly smaller home than they originally planned, but it was a home they knew with 100% certainty they could afford for the long haul. That 1-hour consultation didn't just save them from a bad loan. It saved them from years of potential financial stress and regret. Put them in control. This isn't just one story. Variations of this happen in every city, in every state, every single day. The system is complex, and that complexity can be used to obscure the truth. Having an independent educator and a compliance review on your side is like turning on the floodlights in a dark room. It removes the guesswork. It eliminates the blind trust. It replaces anxiety with confidence, because you're no longer just a participant in the process. You're an informed, empowered leader of your own financial future. You're not just hoping you got a good deal, you know you did because you had an expert who works only for you confirm it. So, you understand the why, the critical need for a second set of expert eyes. But the how is just as important. How do you find a reputable mortgage educator, and not just another salesperson in disguise? What does a real compliance review look like? What specific documents do you need to have ready? And what are the exact red flags they're searching for? We're about to pull back the curtain on the exact process, giving you the step-by-step playbook to build your own team of advocates. First, let's talk about what this process actually looks like. It's not some shadowy backroom deal. It's a clear, structured consultation, a financial health checkup for the biggest purchase of your life. Think of it like hiring a personal trainer before a marathon. You don't just show up on race day and hope for the best. You train, you plan, you identify your weaknesses, and you build a strategy for success. This is the financial equivalent. The first meeting is a diagnostic session. A good mortgage educator or compliance reviewer isn't trying to sell you a loan. Their only product is clarity and protection. They'll sit down with you, either in person or virtually, and the first thing they'll ask isn't about your bank balance. It's about your goals. Where do you see yourself in 5 years? What does this home mean to you? What are you most afraid of in this process? They're building a psychological and financial profile, because the numbers only tell half the story. Your job in this first meeting is to be an open book. This is a judgment-free zone. The more honest you are about your situation, a past bankruptcy, a period of unemployment, a messy financial partnership, the better they can prepare your file for the brutal scrutiny of underwriting. From there, we move into the single most critical phase, the pre-underwriting audit. This is where your advocate puts on the hat of the most skeptical, cynical, detail-obsessed underwriter imaginable. Their goal is to find every single flaw in your financial story before the lender does, so you can fix it. This is where you assemble your document arsenal. Let's get specific. First, pay stubs. They'll want to see your most recent 30 days at a minimum. They're not just looking at the final number. They're analyzing the consistency. Is your overtime reliable? Are your bonuses guaranteed or sporadic? An underwriter sees inconsistent income as a risk. Your advocate will identify this and help you frame it correctly, perhaps by averaging it out over a longer period or providing a letter from your employer. Next, tax returns and W-2s. You'll need the last 2 years period. If you're a standard W-2 employee, they're looking for stability and upward mobility. But if you're self-employed, a freelancer, or have significant side income, this is where the real work begins. They will dissect your Schedule C, your K-1s, your 1099s. They're looking for trends. An underwriter who sees a 20% drop in your self-employment income from one year to the next will slam on the brakes. Your advocate sees this coming a mile away. They'll work with you to draft a letter of explanation, a LOX, that proactively addresses the dip. Maybe you invested heavily in new equipment that year or took a family leave. You provide the context, they provide the bulletproof explanation. Then comes the big one, bank statements. You'll need at least the last 2 months from every single account you have, checking, savings, investment, everything. This is a forensic analysis. They are looking for red flags with a magnifying glass. The number one killer of mortgage applications is large, undocumented deposits. That $20,000 your parents gave you for the down payment? To an underwriter, that's not a gift. It's a secret, undisclosed loan until you prove otherwise. Your advocate will immediately flag this. They'll provide you with the proper gift letter templates and instruct you on getting the paper trail. A copy of the check, a printout of the wire transfer, and even a statement from your parents' account showing the funds leaving. You are building an unshakable fortress of evidence. They're also hunting for other things. Regular payments to an individual? That could be an informal loan or alimony you didn't disclose. Bounce checks or non-sufficient funds fees. That signals financial instability. They're building the lender's case against you, so you can dismantle it piece by piece before it's ever made. Finally, they'll pull a tri-merge credit report, seeing exactly what the lender will see. They don't just look at the score. They analyze the DNA of your credit history. They'll see that medical collection account you forgot about from 3 years ago. They'll see that you've maxed out a credit card, even if you pay on time, which crushes your debt-to-income ratio. They'll pinpoint these issues and give you a concrete action plan. For example, pay this credit card down to below 30% utilization before we apply. It could boost your score by 40 points and get you a better interest rate. Or, this collection account is small. Let's pay it off and get a letter of deletion from the creditor. This isn't just advice. It's a strategic playbook. After this deep dive, you get what I call the red flag report. It's a clear written summary of every potential issue and a step-by-step guide to resolving each one. You're no longer in the dark. You have a tangible roadmap to becoming the perfect borrower on paper. But their job isn't done. Once your file is pristine and you've been pre-approved, you'll eventually get an offer from a lender. This is where the compliance review kicks in, and your advocate switches from being your personal trainer to being your bodyguard. They take the lender's documents, specifically the loan estimate and later, the closing disclosure, and put them under the microscope. The loan estimate is the lender's initial offer in a standardized format. Your advocate will scrutinize every single line item. Are the origination charges, the appraisal fee, the title fees in line with industry standards for your area? Or are they inflated? They're hunting for what we call junk fees, vague, unnecessary charges padded into the loan. They'll compare this lender's offer against others, ensuring you're not just getting a loan, but a fair one. Then comes the grand finale, the closing disclosure. By law, you must receive this document at least 3 business days before you close. It finalizes all the numbers. Your advocate's job here is to perform a side-by-side comparison with the loan estimate. The numbers should be nearly identical, but sometimes they're not. A last-minute fee appears. The title insurance cost mysteriously jumps by $600. The interest rate lock charge wasn't disclosed properly. This is where your advocate earns their fee 10 times over. They will immediately call the lender and the title company and demand an explanation. They speak the language. They know the laws like the TILA-RESPA Integrated Disclosure Rule or TRID. They know what fees can and cannot change between the LE and the CD. They will fight for you to have those errors corrected before you sit down at the signing table. This isn't a negotiation you want to be having by yourself, under pressure, with the keys to your new home on the line. They are your professional, unemotional shield, ensuring the deal you were promised is the deal you actually get. By going through this two-part process, the internal audit of your own finances and the external audit of the lender's offer, you fundamentally change the power dynamic. You are no longer a hopeful applicant at the mercy of the system. You are a prepared, educated, and protected buyer who is in command of the process. You've transformed your application from a collection of papers into an undeniable case for approval. You've built your fortress brick by brick, with irrefutable documentation. You're walking into the lender's office not with hope, but with the quiet confidence of certainty. But how do you find these specialized advocates? And what's the true long-term financial impact of getting this right from the very beginning? That is the final and most crucial piece of this entire puzzle. Finding them requires a shift in your search. You won't see their faces on billboards or hear their jingles on the radio. They don't sponsor local sports teams. Their currency is expertise, not volume. You have to seek them out intentionally, because the system isn't designed to lead you to them. Start by changing your vocabulary. Stop searching for mortgage lenders and start searching for independent mortgage consultants, mortgage compliance auditors, or fiduciary mortgage advisors. The key word here is independent or fiduciary. This means their legal and ethical obligation is to you, not to a bank, not to a lender, not to a sales quota. When you find potential candidates, you become the interviewer. This isn't a sales call. It's a job interview for the most important financial advisor you might ever hire. And you need to ask the tough questions. The first and most important question is always, how are you compensated? If the answer involves a commission from the lender, a percentage of the loan amount, or anything other than a flat, transparent fee that you pay them directly, they are not your advocate. They are a salesperson with a different title. A true educator or compliance expert works for you and only you. Their fee, whether it's $1,000 or a few thousand, should be the only money they make from your transaction. Next, ask for proof of their process. Can you walk me through a redacted compliance review you've done for a past client? What specific items do you look for on a loan estimate and closing disclosure that an average homebuyer would miss? What is your philosophy on paying points to lower an interest rate? Their answers will reveal everything. A salesperson will give you generic advice. An advocate will talk about amortization schedules, break-even calculations, tolerance cures, and the specific RESPA violations they hunt for. They'll speak with the precision of a surgeon, not the enthusiasm of a cheerleader. Look for credentials, but more importantly, look for a mindset obsessively focused on client protection. But let's move past the how and get to the why. What is the tangible dollars and cents difference this makes over the life of your loan? This is where the story splits into two parallel universes. Let's imagine two couples, both with identical financial profiles. They have great credit, solid jobs, and a 20% down payment for a $500,000 home, meaning they need a $400,000 mortgage. First, we have Mark and Jessica. They follow the traditional path. Their real estate agent, who is wonderful at finding houses, gives them a list of 3 preferred lenders. This list is based on relationships and a track record of closing deals on time, not necessarily on getting the best possible terms for the buyer. Mark and Jessica call the first one. The loan officer is friendly, builds great rapport, and quotes them a 6.75% interest rate. It sounds reasonable in the current market. They get a loan estimate, and it's a sea of numbers they don't fully understand. There's an underwriting fee, a processing fee, a courier fee. It all seems official. They're told it's standard. Anxious to lock in the rate and secure their dream home, they sign. They feel relieved. They got their loan. Now let's look at our second couple, Ben and Chloe. They decide to take a different route. They spend a week researching and find an independent mortgage educator. They pay him a flat fee of $1,500 to be their advocate. He tells them to apply with 3 different types of lenders. a big national bank, a local credit union, and a wholesale mortgage broker to cast the widest net. They receive 3 loan estimates. This is where their advocate goes to work. He lines up the 3 documents side by side. The first thing he notices is the interest rate. The bank offered 6.75% just like Mark and Jessica got. But the credit union offered 6.625%, and the mortgage broker came in at 6.5%. Already, by simply creating competition, Ben and Chloe have a better offer. But the advocate isn't done. He then dissects the fees in box A, the lender's origination charges. He sees the bank is charging a $1,200 underwriting fee and a $995 processing fee. The credit union has lower fees, but the mortgage broker has the lowest of all. The advocate points out that processing and underwriting are fundamental costs of doing business for a lender, and charging for them separately is often just a way to pad profits. He then calls the first lender, the one at 6.75%, on behalf of Ben and Chloe. He doesn't just ask for a better deal, he presents evidence. He says, "My clients have an offer in hand for 6.5% with total lender fees of only $1,000. Your offer is 6.75% with fees totaling over $2,000. We'd like to work with you, but you need to match or beat these terms." Suddenly, the conversation changes. The lender, knowing they're dealing with an informed party and not a novice, magically finds a way to drop their rate to 6.45% and slash their fees in half. Let's do the math on these 2 diverging paths. Mark and Jessica, on their $400,000 loan at 6.75%, have a monthly principal and interest payment of $2,594. Over 30 years, they will pay a staggering $533,931 in interest alone. Ben and Chloe, after their advocate's negotiation, secure a rate of 6.45%. Their monthly payment is $2,516. That's a difference of $78 a month. It doesn't sound like a fortune, does it? But let's look at the big picture. That $78 a month adds up to $936 a year. And over the 30-year life of the loan, Ben and Chloe will pay a total of $505,799 in interest. Their advocate also saved them over $1,000 in junk fees at closing. So the grand total? Mark and Jessica paid nearly $534,000 in interest. Ben and Chloe paid under $506,000. By investing $1,500 up front, they achieved a net savings of over $29,000. That is a new car. That is a year of college tuition. That is a significant boost to their retirement accounts. They didn't just get a loan. They executed a financial strategy that will benefit them for decades. But the true impact transcends even that $29,000. It's about the transfer of power. Mark and Jessica experienced the process as something that was happening to them. They were passengers hoping for a good driver. Ben and Chloe were the pilots. They understood the controls. They directed the outcome. This created a foundation of confidence for every financial decision they would make in that home, from refinancing to home equity loans. They didn't just buy a house. They bought it with the certainty that they had secured the absolute best terms possible, leaving no money on the table. This is the final fundamental truth of the American mortgage system. It is a complex, opaque machine designed to maximize profit for the institutions that run it. It is not inherently evil. It is simply business. But when you are on the other side of that transaction, you cannot afford to be just a customer. You must have an expert in your corner, someone whose only job is to deconstruct that machine and make it work for you. Choosing to go through this process without an advocate is like walking into a complex lawsuit without an attorney. You might be fine. You might win. But you will never know what you could have gained, what you might have lost, or what traps you narrowly avoided. The cost of a mortgage educator or a compliance review isn't an expense. It is the single highest return investment you can make in your home buying journey. It transforms the single biggest liability of your life into a well-managed, optimized asset. The most expensive part of your mortgage isn't the interest rate printed on the page. It's the knowledge you don't have, the questions you don't know to ask, and the advocate you didn't hire. The choice is yours.